When I look at the action of OPEC Plus, nobody is surprised, but yet the world would be politically disappointed that OPEC are not doing more. Do you think the mantra from OPEC that it's not their responsibility to step in and supply more still holds, or will they more? Do you pay a price for this?
Good morning, Manos. Well, you are right that we were not surprised by OPEC's decision because, look, a month ago when the war started in Ukraine, oil prices, Brent, hit nearly $140, and OPEC, just continued with their strategy to stick to their agreed monthly increase of 432,000 barrels a day. So I was not going to expect them to deviate from their policy today. Now, they cannot, at some point they will have to act on what they have been preaching, that is focusing on market stabilization. But they seem to be living in their own world in the sense that they kind of denying that Russia is going to lose major oil production because of potential EU bans on its exports, and that will have repercussions on the market. But at the same time, you have to see where they are coming from, at least based on market fundamentals. Everybody's warning from a looming recession. You have more supplies coming to the markets through the strategic petroleum reserves. Even before the crisis started, we're expecting
Carol,
more supplies
hold those thoughts. Carol, I'm going to interrupt you just very, very briefly. Hold those thoughts on the risks, because side by side with you, Carol, we are showing the pictures. This is Dragon Crew 3's Dragon capsule descending back to Earth. These are live pictures coming to you. Obviously, it left and undocked from the space station. Splashdown is expected in just the next few minutes. So these are the parachutes already being deployed, as you can see, as we return to the Florida coast. Now, on board here, you have three astronauts. You have a number of astronauts. Rajachari, Tom Marshburn, Kyla Barron, and Matthias Maurer, now, who flew to the space station on Dragon when Falcon 9 launched the spacecraft from the launch complex. That was at Kennedy Space Center. We'll track those images for you and return to my guest, which is Carol Knackel. Carol, as the EU goes to cut off Russian oil over the next 6 months, a couple of questions come to mind. Where does Russia sell all its oil? Will it all go to China? And what is the risk of that?
Well, no, you cannot diverge all your oil suddenly to a new market. There will be some of it that will continue to make it to the market. Already, for example, we see India taking advantage of the Urals trademark Russian crude selling at a discount, and so are other refiners around the world, particularly in Asia. But I doubt Asia, given the current economic situations there, the slowing of economic growth in the largest oil importer in the world, that is China, I doubt Asia will be able to capture all of Russian oil. It will capture a significant proportion, but there will be repercussions on Russian production, which is we're going to see some loss in Russian production because they are unable to sell all their oil if they lose access to the entire European market.
Yeah, as you say, China's not necessarily going to take everything in one fell swoop. Carol, just to mention for our viewers, we're looking at Splashdown. We are Splashdown on Dragon. Let's listen in.
All right, as you can see there on your screen, Dragon Endurance carrying Crew 3.
Copy, we see the same and main attack.
Crew 3 crew has splashed down in the Gulf of Mexico off the coast of Florida. So right now, Dragon is
on behalf of the entire SpaceX team, welcome home.
Welcome home to SpaceX's team. There you go, Carol. Never did you think that your interview would be interrupted by a SpaceX landing. So well done, and thank you for watching alongside that. It's the very personification of our future. But that brings me to what is the future for Europe. I had Amrita Sen with me yesterday morning, and she said there's just no way Europe is going to be able to wean itself off Russian oil in 6 months. Do you agree? And who is going to fill that gap, in your opinion?
I mean, it's no-brainer. The EU is a major oil consumer in the world. It's the largest economic bloc in the world. And they've been relying on Russia for decades for both oil and gas. So we have to be realistic. We are not expecting them to suddenly turn their back completely on Russian oil. And this is why I believe there will be some waivers, some exemptions for some countries. And that by itself is going to weaken the imposition of sanctions, full imposition of sanctions on Russia. But there is oil out there. And even before the war, Manos, we were expecting additional supplies to come from outside OPEC from the second half of this year. And the beauty of oil markets is that they are global and they are fluid. So, and they send the right signal to consumers. So there's also the demand side. So there will be supplies going to respond and demand is going to respond, especially in the light of the current macroeconomic outlook, which doesn't look terribly encouraging for oil demand.
What's the risk then that Europe cuts off the gas? Can they cut off Russian gas, Carol, or is that just almost an economic suicide?
I call it the nuclear option but they seem to be heading in that direction. But gas by its nature is very different from oil. You have different level of infrastructure. The market is not global. You do have LNG, but LNG is not really a big proportion of gas trade. It's mostly pipeline. So that by itself, that's why you saw that they started first with coal because it was the easiest to replace. Then they are moving gradually on oil, but gas will be very, very difficult to turn their back away from Russian exports immediately. Or even within a year. That will take some time, and the EU recognizes that.
Jamie Dimon yesterday said $30, $40 could be packed onto the price of oil in the event of an extended, protracted, or a more heightened level of tension between Russia and Ukraine. Do you think the war premium, Carol, for protracted, extended conflict and escalated sanctions is $30, $40, or is that cheap?
Well, really, nobody knows what the premium, the geopolitical risk premium is when it comes to prices. We've been guessing this for years, if not decades. Sometimes it goes to $6, sometimes it goes to 30 or 40. But I have the feeling that we've already absorbed the shock of the war in Ukraine, and we've been already prepared psychologically, if you want, at least to potential oil embargo coming from the EU. But we should not only think in terms of supply, the demand. If you ask me what is the biggest factor today, apart from the Russian-Ukraine war, I would say is the demand outlook, the macroeconomic outlook, which doesn't look that encouraging to support this kind of major premium.
Yeah, well, now people are beginning to talk about recession in the UK, recession prospects on a hard landing in the United States of America, COVID-0 in China. So maybe we need to talk more about the demand side as well. Carol, thank you very much. My guest this morning, Karen Knuckle, CEO at Crystal Energy. Very latest on the markets and energy outlook right here on Daybreak Middle East. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The Bank of England issued perhaps the gloomiest outlook of any major central bank this year. It raised its key rate as well. The Governor, Andrew Bailey, is warning Britain to brace for double-digit inflation and a prolonged period of stagflation or even a recession.
I wouldn't agree with the statement that the cure for higher inflation is higher inflation. But I just want to go one step behind that because I think it's important. We think that a lot of the work in terms of the cure is going to be done by the fact that we are experiencing a historically large shock to real incomes in this country coming from outside the country. So it's a terms of trade shock in that sense. Import prices are rising. That's predominantly energy, food and some core goods. So I just wanted that high inflation cures high inflation. No, of course it doesn't in a sort of what you might call a sort of standard demand shock where both activity and inflation are going up. But what we've got is inflation going up and this big push down on real incomes. And it's the real income push that is the thing that we think will do a lot of work to lower inflation. But here's the complication. There are risks the other way, and one of the big risks the other way is the labour market. We've got a very, very tight labour market in this country. Now, of course, it's a good story in many ways for broader society and economy because we've come through COVID. There were a lot of predictions, including some by us at some times, that we were going to have quite a big rise in unemployment, and in the end it didn't happen.
Why are you so convinced that wages are not going to rise to meet the inflationary push that we're seeing? I hear what you're saying about the cost of living crisis, but nevertheless, there is a risk that we see wages going higher. You talked about this in the press conference. There seems to be a gap between the bank and business. I talk to CEOs all the time. What they tell me is they are really struggling to hire. They are, as a result of which, having to raise wages to compensate for that. And as a result of which, while at the moment wages are below where inflation is going to come down, but the labour market may stay tight and we end up with a situation where actually that spiral starts to bite. That's
why we think there are risks on the upside to inflation, but we also think that the core story here is a big real income shock to the country, national real income shock, which will push down both on household income and company income, cuts down on corporate margins as well. And that, we think, is going to slow the economy down. It's going to slow demand in the economy down. And we're probably already seeing some signs of that. I mean, look at the gap between consumer confidence and business confidence in this country, which is quite large at the moment. We had and I never advocate putting too much weight on one number, but we had quite a weak retail sales number a couple of weeks ago. So we are seeing some signs of things beginning to happen. And we think, unfortunately, this shock to real income has to come through. I mean, there's no way it can't go anywhere else, unfortunately, and that will affect. But you're right. I mean, I go around the country a lot. At the moment, and this backs up the business confidence story, firms are saying, my problem is I can't hire enough people.
Andrew Bailey there sitting down with Guy Johnson. As my guest this morning said, Andrew Bailey said the quiet part out loud. And that is Britain's cost of living crisis. It was one of the key issues in the local elections that took place yesterday. The results are beginning to trickle in. Let's get to London HQ. Leanne Gerrans is standing by. So what do we know so far? Did Partygate deliver a bloody nose to the Tories, or did it just not pass through, as they say?
Well, Manus, this is an interesting question, but we have to just know that it's a mixed bag at the moment. We don't have all those results, but it is important to just highlight that Labour are really celebrating here in London. They have won Wandsworth Council, which the Tories have held for 44 years, and they often said was the crown jewel in their bag of London councils. So that is really a blow for Boris Johnson here in London. And there's also rumours that Westminster Council could also fall from the Tories to Labour. We're waiting for those results to come in. As you said, they are trickling in, and the Green Party has done really well, as have the Lib Dems. But, you know, what you've said is really interesting on the cost of living, not so much Partygate. A lot of Tories, so we're seeing one council seat fall in 6, so it's less of a blow to the Tory party, but the Tories are saying that those who are losing the councils, it's really down down to the cost of living crisis, Manus. And we've seen this time and time again. People are really beginning to struggle and they are asking for more change. And of course, we just heard from the Bank of England governor there, Andrew Bailey. And yesterday we saw interest rates rise. So they now 1%.
Well, Leanne, let's just pause for a moment there in terms of what we're hearing from the Bank of England. My guest this morning said Andrew Bailey said the quiet part out loud. It was really quite damning in terms of they've put a number on how many people need to lose their job to quell inflation.
600,000 people was the number that was put on that to quell inflation and tame it. And that's something that we have to look at realistically. And as we know, interest rates are going up and so is inflation. So this is going to dampen domestic spending. And people are saying that this is also going to cause a cost of living crisis if people lose their jobs here in the UK. So normally the local elections, Manus, aren't really looked at as something big. But this is a litmus test for the Tory government at the moment. And there are calls for the Chancellor Rishi Sunak to do more to help people. And even Andrew Bailey said it's those people on lower incomes that are going to suffer the most. So we'll see if this is going to change the outcome and if the Tories will make differences to help those people.
Leanne? Let's see what the next couple of months brings in terms of the data for the Bank of England. Leanne Garrans, we'll see you through the morning. I want to take you straight to the global market map. It is brutal in terms of the commodity, equity and rates narrative. Australasian equity markets playing catch up with the 1.3 trillion that was wiped off the US equity markets yesterday. To the commodity markets, again, hard landing. And perhaps a more brutal reality of recession takes copper down by 1 1/4, and the rates market reappraises risk. This is Bloomberg.
En nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente.
Incoming mail.
Y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
I think what we've seen during this period of time is that
communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Daybreak Europe. I'm Danny Berger in London alongside Manish Krani in Dubai. The stories that set your agenda.
Market maelstrom. U.S. stocks crater, wiping out $1.3 trillion. The sell-off continues in Asia as inflation concerns hammer the bonds. No to neutral. Former Fed Vice Chair Richard Clarida says rates need to hit at least 3.5% to tame inflation. Jobs data today will provide the next clue. Plus, the Hawks fly in Frankfurt. Austria's Robert Holzmann says the ECB could decide on a rate hike next month, with other governing council members pushing for July. Danny, good morning. As John Arthur says, we've just hit a brontosaurus moment, and that is what's happening in markets. Good morning.
Good morning, Manis. Let me tell you how bad this market sell-off is. This is basically my barometer. It was so bad that we had folks out there quoting the move in points dropped in the Dow. That is a cardinal sin in my book. We don't do that here on Bloomberg Daybreak Europe. Let me show you what these equity markets are doing so far this morning. You're looking at a little bit of a bounce back, or not as bad as we had seen yesterday when it comes to S&P 500 futures. Of course, nothing like yesterday, but still a decline. Man, is the average decline so far this year 2.3 days. That's the longest amount of selling that we've seen since the 1980s. So NASDAQ futures down more. It's those long-term duration assets. The Fed, we all of a sudden decided yesterday that they are indeed hawkish, a head fake from Wednesday's move. Euro stocks futures not down as bad as you'd expect if they were to play catch-up with the U.S. So really that sell-off yesterday concentrated in U.S. stocks. And finally, MSCI Asia Pacific down more than 1.5%. A lot going on with China tech. We'll get that with Juliet Sally in just a moment, Manis.
The question is, Danny, what exactly broke in market yesterday? Was it confidence that a soft landing could be achieved at all? To the pound, my guest in the last hour said Andrew Bailey was the one that quietly laid out the truth, and it was most manifest in the pound. We'll come back to the pound in just a moment. Collapsed by the most since 2020. But this gives you a sense the dollar is at a 20-year high. Dollar yen, 9 weeks of a rally in the dollar, 9 weeks in a row in which the yen collapsed. So you are just seeing Bitcoin, the correlation with equities, as at a record high, down by 8% yesterday. And bonds, 10-year paper at 3.05%. There is almost a Damascene Soul, Damascus Road moment in the bond market where a recession cannot be avoided if you're going to quell inflation. But this is the moment when Bailey spoke, the pound collapsed by over 2%. And this is the very personification of reality. Double-digit inflation and a recession on the way in the UK. It's going to be darned hard to avoid it. Danny.
Certainly that feeling of capitulation. Man, some breaking lines to bring us. ING earnings coming in. The Dutch bank, a miss when it comes to their earnings and higher loan loss provisions than had be expected. Loan loss provisions, those are coming in 987 million euros. Estimate was just under 700 million euros. It's all about Russia, Manis. ING, their impact from cost link to Russia, 834 million euros. ING, one of the biggest exposures to Russia of European banks. Of course, we're going to be speaking with the CFO of the bank himself, Tanate Foudrecool, on their first quarter earnings. That'll be just a little bit later in the show, Manis.
Okay, let's see what Tanate makes of these market moves. Let's get to our reporters around the world and set the context. We have our executive editor for markets, Paul Dobson. He will bring us up to date on what broke and caused the market sell-off. Just ahead of the jobs report, we're going to speak to our senior Asia economy reporter, Michelle Jamrisco. And then we turn our attention to the ECB with our Bloomberg reporter, Maria Tadeo, on the ground. Jules is in Asia, tying up the time zones for us, a sea of red. Danny, take it away.
Well, let's talk about the puking in yesterday's market. It was just one day after it had celebrated the Fed signal that there wouldn't be, in the words of Manus Cranny, any jumbo-sized hikes. Now, markets have made an about-face. It wiped out more than $1 trillion of value. So let's get straight to Paul Dobson, our Asia markets editor. Paul, what broke yesterday?
Yeah, well, I think as Manos was saying, you know, the BOE really kind of like laid it out, told us how it is, right? Maybe we hadn't quite got that from the Fed. This idea that you're almost damned if you do and damned if you don't, right? If you step back from the pace of easing, the back end of the bond curve keeps on going higher. You know, the pain in fixed income continues, and that just reels right back to equities as well after a while. But if you slam on the brakes too tight, then the market hates it as well. So, you know, kind of like wonderful environment for a trader, you know, a day trader coming in and out with all this volatility. Terrible, terrible environment for a long-term investor. Can't get safe in bonds, can't get safe in equities, all looking very bleak.
Yep, I still put it to you, Paul, that taking that 75 basis points off the table was their moment to re-grasp the nettle. Our markets editor in Asia, Paul Dobson, there. Let's talk about the jobs data. That's actually out later on today, leaving the Fed with a pretty complicated path as it ramps up the fight against inflation. Let's get to our Asia economy reporter, Michelle Jam-Risco. So, Michelle, Clarida, former vice chair, says they're going to need to go to 3.5%, which is nearly 1 full percentage point above the assumed neutral rate. How likely is that?
Well, leaving aside the debate about the neutral rate that we've been having for years now, you know, just the idea that they would move that fast is kind of up for debate, especially after the Fed action this week, producing such mixed feelings about what's next. And of course, you see that in the markets, as you and Danny have outlined all morning. With the jobs report, though, that this is going to be very tricky. By all accounts, we should see another robust figure, monthly jobs figure. We should see downward pressure on the unemployment rate that then produces upward pressure, of course, on wages. Still a lot of job openings out there. That's really going to complicate things for the Fed that wants to kind of carry on at a certain measured pace with these rate hikes. I mean, they have already ruled out, at least Powell has, that 75 basis point hike, as you mentioned. That was kind of working in the dovish tone favor, but we are seeing a lot of hawkish signals, not least because we still have the ongoing conflict in Ukraine. We have this sort of global race to the upside in terms of hikes with the RBA, RBI, and BOE, of course, among them this week, a long list that are hiking. So a lot of pressure on the upside. This jobs report is again, it's just going to complicate things.
1:30 p.m. UK time. That's when the jobs report comes out. Michelle, thanks so much. Bloomberg senior Asia economy reporter Michelle Jam-Risco. Now to the EU, where top policymakers gather today at a special seminar in Salzburg to discuss the continent's policy response. We have governing council members calling for hikes within the next 2 months. Of course, Panetta, the one standout, saying we're in stagnation in Europe. For more, let's go to our European correspondent, Maria Tadeo, reporting live from Salzburg. Maria, is Panetta the lone dove at this point?
Fabio Panetta, absolutely not. And you know, Danny, I wouldn't just say he's a lone dove here. He's no longer a dove. When you look at that interview that he gave yesterday to an Italian newspaper 2 days ago, saying when I look at the situation now, when you look at the picture in the European Union, we're in de facto stagnation. We are going to potentially see a big decline to growth. Everyone now assumes that the European economy, the euro area, will barely grow this year. And of course, inflation just keeps jumping. So, you know, for me, it was very striking to hear that out of Panetta, someone who usually stands on the other side, now essentially saying we're in stagflation. And yes, the ECB is probably going to have to take action. And a lot of this, Danny, will also dominate the conversation here in Salzburg. I'm at the Global Europe Seminar. European officials, central bankers, Olli Rehn, by the way, will be here. Paolo Gentiloni, the Economic Affairs Commissioner for the EU, will also be here. And a lot of this is about figuring out where we go from here, perhaps some clarity from European officials. But Danny, if there's something I've picked up over the past 48 hours here is that really it's all about the uncertainty. It is the war in Ukraine, the second round effects of the sanctions here. And of course, it's very difficult to measure what this will do because who knows how this war is going to end. So there's a lot of uncertainty here. I would definitely argue that is the biggest concern now in the European economy.
Maria, thank you very much. Maria Tadeo reporting from Salzburg on the very latest ECB projections. Now, the global sell-off, it's wreaking havoc in Asia with the stocks, with the bonds, with the currencies, all of them in tandem are falling. Juliet Sally has a sea of red on her screen behind us. Jules, is there any reprieve? Is there any hint of pause in any of this market demolition?
There are a few upsides. I'll get to those in a moment. But broadly, Manus, we are on track for the worst week since March for Asian equities. We're at pandemic lows. You've got bonds being sold off. The Aussie curve steepening. The 10-year yield has been up by as much as 11 basis points. And another tough session for the Hang Seng Tech Index after we saw that demolition coming through in US ADRs. When it comes to Japan, though, remember it has been out of action. We've had PM Kishida talking about loosening border controls from next month. That's helping out the reopening stocks. And we've also got this report too that China is to dump foreign PCs within the next 2 years. You've got the likes of Lenovo in Hong Kong rising. It is a story, though, of dollar strength, as we know. Let's flip the board and have a look at what has happened to the offshore yuan, testing that 6.7 level against the dollar. That is a fresh 18-month low. Of course, we're looking for further dollar appreciation, so expecting these losses to accelerate in both the on and offshore currencies. It's really got to be a very soft NFP to take anything away from dollar strength. Danny.
Jules, great roundup. Bloomberg's Juliette Sally there with the latest market action. And let's take a look at what other market action could be happening. The key things market participants are watching out for today, 1:30 p.m. UK time, April's U.S. non-farm payroll stats. It's Jobs Day. Happy Jobs Day to everyone. Also, 1:30 p.m., Canada releases its latest unemployment data. Manus?
Well, at 2 p.m. then, Danny, the SEC annual conference on financial market regulation kicks in Pennsylvania. At 4 p.m., California's Hoover Institute hosts a monetary policy conference, and you're going to get the Fed Governor Chris Waller and the St. Louis Fed President James Bullard. Of course, he is the arch hawk, speaking a little bit later today. We'll also get the UN World Food Situation monthly report for April is released. Coming up on the show, Danny, the CFO, Tanate Futrikul. He joins us for the first quarter earnings from the Dutch bank ING. That interview coming up on Bloomberg.
And also later on the show, Manus, we're going to talk about Wall Street bonuses, which plummeted by as much as 40% this year, or at least is expected to on the back of a banking slump. We'll get you the details. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to Bloomberg Daybreak Europe. I'm Danny Berger in London alongside Manus Cranny in Dubai. Manus, while the world was transfixed by pricing and a more hawkish Fed, something very different was going on here where I am in the UK. Warnings from the BOE of potential economic damage as they hiked rates to 1%, saying that the economy might shrink Let me take you to sterling, falling its most since the start of the pandemic, Manus. Again, this is really the standout central bank yesterday when bonds everywhere were crashing.
Absolutely. And, you know, that's one of the biggest days drop in the pound, Danny. I think that was your factor today since March 2020. It was a 2% crash. But it's the bond market. I mean, the debate is this, stagflation. How real is stagflation already in the UK? Bailey calls inflation potentially up over 10%. And he also says there's a possibility of a recession. So the bond market suddenly took this dramatic repricing, which in many ways is part of the reason why you saw the big move in the currency as well. The UK, 25 basis point move in 2-year paper, and that was taking you down. A big move, the biggest one-day move in 2-year bonds since the day after Brexit in the United Kingdom. So you're just seeing yields drop a little bit further, 1.54 at the moment. Let's move along. ING has reported lower than expected earnings for the first quarter. The net income, 429 million euros, well below the 590 million euro estimate. And it said that it had reported an impact, 834 million, in terms of the risks linked to Russia. Let's have a conversation with the CFO of ING. It is Tanate Phutrakul. He joins us now. I've just read out the number for your exposure to Russia. Is that the worst case scenario? Tanate, good morning. Good to see you. Or do you expect it to be materially higher? And how quickly will you wind the business down? Good morning.
Hi. Good morning, Magnus. It's been a turbulent quarter in Q1. Having said that, I think if you look at our underlying operations, our results are actually quite resilient. If you look at our net interest income, it's actually risen in the first quarter, some tailwind from rising interest rate. Our fee incomes is actually one of our strongest quarter in recent times, and our costs are actually down in Q1. And that has generated sufficient capital for us to absorb and contain the Russia situation.
I need to jump in here. I need to jump in here on Russia because, yes, results strong, but still 834 million euros in costs related to Russia risk. Can you guarantee to investors that that's the extent of damage emanating from the region?
Well, I think we are taking an assessment. Things can evolve, but as of Q1, we think we are appropriately provisioned for that. We are also reducing our exposure to Russia. I think in the last 60 days since the crisis has broken, we have already reduced our exposure to Russia by over 1 billion euros. And that de-risking and that reduction of risk to our Russian customers are continuing.
Where is your biggest exposure in Russia? What have you got left there, Tanate? What are you going to struggle to manage down?
I don't think we would struggle to manage. I think what we need is time for customers to repay us back. We have a split between onshore and offshore Russia risk. And what we do see is that our offshore Russia risk is reducing at a good pace.
Tanate, 7.2 billion euros in Russia-Ukraine exposure. Do you run those down or do you sell them?
We are actually running it down. So we have, as you mentioned, close to 7 billion euros, and we're down to roughly 1 billion less within the last 45 days or so.
Tanate, we've seen massive repricing in bond, equity and currency markets in the past 24 hours. There's talk now of the ECB raising rates. Let's talk about market dislocation and recession risk in Europe. Is it now a very real risk, and will you materially change any of your lending criteria as we go towards the end of 2022?
Yeah, so I think I think we mentioned before, we think rates needs to move up now in the Eurozone, and we expect that the ECB will respond shortly. Having said that, I think we have always been a conservative shop in terms of risk management. And if you look aside from the Russia risk, our book remains very solid. We actually saw very little risk cost in Q1. But having said that, we are looking at a scenario of stagflation in 2022. And we continue to be conservative and prudent in terms of our risk management. And if you see over the cycle, ING has managed its credit risk quite well.
Even so, Tanate, when you see days like yesterday, tell us what conversations with clients, with peers, what those have been like in terms of the sense of fear you're seeing out there.
It's a lot of concern by both retail and corporate customers. And I think what we have told them is that rates are rising, that we have gone through now a rotation from very benign market situation, very low and negative rates, to more positive rates, and that our customers, both retail and wholesale, needs to get used to structurally higher levels of inflation. And we do help our customers to make sure they can adjust to that new reality, and ourselves as well, of course, in terms of our business model. We have to adjust to this new, rising rates environment.
You've used the word stagflation. Andrew Bailey, some would say, told the truth yesterday in terms of what people can expect, double-digit inflation and a recession. If you're facing stagflation, is it just no longer possible that you will deliver a lending growth number of a growth of around 5% if your base case is stagflation?
It would be more challenging, and we would be, of course, more cautious in terms of extending credit. But we gave guidance to the market that we expect lending to grow between 3 to 4% over time. But we think, given where we see things in 2022,
so what is the deliverable number then? Is it 2% growth, 3% growth? What's the number for the market to expect?
I think what we say is we're on the lower end of that 3 to 4%, so around 3%.
Tanate, reports suggest that Wall Street may shrink bonuses by as much as 40%. Are you seeing something similar at ING?
We have a very different kind of variable compensation structure. Variable compensation is not the biggest part of our cost base, but of course, with the results, the way things are, it will be automatically adjusted based on what we make during the year. But it's early times yet. We only had Q1, so we'll see how that evolves over the course of the next 9 months.
All right, Tanate, you'll have to keep us updated on that front. Thanks so much for joining us this morning. ING CFO Tanate Phutrakul. Coming up, the Bank of England governor paints a gloomy outlook for the UK economy. As Manus and I were discussing, that story of growth expected to slow sharply and the impact to UK assets. We've got more from Andrew Bailey next. This is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Welcome back to Bloomberg Daybreak Europe. I'm Danny Berger in London, Manus Cranny in Dubai. Now, the Bank of England issued the gloomiest outlook of any major central bank this year, even as it raised its key rate. Governor Andrew Bailey is warning for Britain to brace for double-digit inflation and a prolonged period of stagnation or even recession?
I wouldn't agree with the statement that the cure for higher inflation is higher inflation. But I just want to go one step behind that because I think it's important. We think that a lot of the work in terms of the cure is going to be done by the fact that we are experiencing a historically large shock to real incomes in this country coming from outside the country. So it's a terms of trade shock in that sense. Import prices are rising. That's predominantly energy, food and some core goods. So I just wonder high inflation cures high inflation. Now, of course, it doesn't in a sort of what you might call a sort of standard demand shock, where both activity and inflation are going up. But what we've got is inflation going up and this big push down on real incomes, and it's the real income push that is the thing that we think will do a lot of work to lower inflation. But here's the complication. There are risks the other way, and one of the big risks the other way is the labour market. We've got a very, very tight labour market in this country. Now, of course, it's a good story in many ways for broader society and economy, because we've come through COVID. There were a lot of predictions, including some by us at some times, that we were going to have quite a big rise in unemployment, in the end it didn't happen.
Why are you so convinced that wages are not going to rise to meet the inflationary push that we're seeing? I hear what you're saying about the cost of living crisis, but nevertheless, there is a risk that we see wages going higher. You talked about this in the press conference. There seems to be a gap between the bank and business. I talk to CEOs all the time. What they tell me is they are really struggling to hire. They are, as a result of which, having to raise wages to compensate for that, and as a result of which, while at the moment wages are below where inflation is going to come down, but the labour market may stay tight, and we end up with a situation where actually that spiral starts to bite. That's
why we think there are risks on the upside to inflation, but we also think that the core story here is a big real income shock to the country, national real income shock, which will push down both on household income and company income, comes down on corporate margins as well. And that, we think, is going to slow the economy down. It's going to slow demand in the economy down. And we're probably already seeing some signs of that. I mean, look at the gap between consumer confidence and business confidence in this country, which is quite large at the moment. We had and I never advocate putting too much weight on one number, but we had quite a weak retail sales number a couple of weeks ago. So we are seeing some signs of things beginning to happen, and we think, unfortunately, this shock to real income has to come through. I mean, there's no way it can't go anywhere else, unfortunately, and that will affect. But you're right. I mean, I go around the country a lot. At the moment, and this backs up the business confidence story, firms are saying, my problem is I can't hire enough people.
Bank of England Governor Andrew Bailey there, painting a gloomy outlook for the UK economy. There are moments of great existential angst, not just in my life, but in bond markets. And this is what happens when 10-year paper drives through 3%. It drags the global bond markets up by their bootstraps, Danny Berger. Aussie rates re-rate up by 8 basis points, and commodities drop on recession risk globally. This is Bloomberg.